Welcome back. You're still tuned into MF Corner, where we spoke about swing pricing in depth and try to understand what this concept is really about. Let's talk about another important and interesting topic. Let's welcome Nirav Karkera, the head of research at Fisdom, and let's try and understand and analyze what does the cash part of a portfolio means when it comes to mutual funds. Nirav, good afternoon. Always a pleasure speaking with you. Thank you so much for joining us today. Well, usually when we look at mutual funds, we talk about what is the equity portion, what are the stocks a fund holds, or maybe if it's a debt mutual funds, what are the constituents there? But is it very important to analyze the cash component of mutual funds? And if yes, how does one do that?
So hi Sonal, this is a really interesting topic to talk about, because often when we talk about funds, we'll end up talking about equities and debt and allocations within it. However, little do we realize that cash as an allocation is also a very critical element that one needs to assess while evaluating a mutual fund. So yes, definitely right at the outside, definitely it is important to consider cash allocation while evaluating a mutual fund. In fact, what's more important than assessing the quantum of cash that has been allocated, it is important to understand the reason and the context why such allocations were made towards cash. There are two primary reasons why cash allocations are made largely. Number one, to manage fund flows, to manage redemptions, etc. You keep a certain small percentage in buffer as cash, so that you don't come under a lot of pressure to liquidate investments each and every time. There are redemption requests that are supposed to be serviced. So this is the straightforward, the simple reason for why cash allocation is made. The second one is something that most people don't seem to acknowledge or appreciate as much, is that cash allocation is also an active fund management call. So especially in terms of equity funds, right? A cash allocation could be a very active way of holding on to dry gunpowder and waiting to deploy those funds if as a fund manager you believe that certain opportunities are going to be available at a better price point. So that's one. Second, cash is also an effective hedge against extreme volatility within the space you're operating in. Let's talk about certain funds, if who typically operate in a very narrow universe, like a sectoral or a thematic fund. If the sector or the theme itself is undergoing a rough patch, a fund manager may effectively hedge his exposure. In fact, it's not quite a hedge; it is defending his exposure to such long positions by holding on to a larger proportion of cash. So this way, there is lesser percentage of the portfolio that is exposed to the rough patch, and this in fact helps the investor makes more in terms of real returns by way of protecting the investors from the downside. So the context is very important. Cash in this situation, as you would realize, it could be an asset or a liability depending on how you use it. If you use it well, if you allocate to cash to defend against rough patches, if you use it to wait out for a better opportunity, it is an asset. However, if you sit on excessive cash while opportunities are available and you do not participate, you always run the risk of underperformance merely on account of being underexposed or having limited participation into the entire uptick that you could have easily participated into if you did not allocate that portion to cash.
That's very helpful because, usually what everyone looks at, as we've been pointing out, it's just where funds are invested and not when it is kept in that cash basis. So, is there a minimum amount that every mutual fund keeps as cash on an average always, considering steady market levels? Is that also something that investors should look at, or it is ad hoc, depends on the funds and the market conditions?
So mostly it depends on the market conditions and the type of fund and the universe that it is operating in. For instance, if you look at ETFs and index funds, where there is no real need to hold on to a lot of cash, because especially not from an opportunistic standpoint, right, or from an performance defending standpoint as well. The cash allocation for more liquid ETFs as well as index funds would be in the range of, let's say, 0.2 to 0.4 percentage types. right, as we speak. However, if you look at certain more actively managed funds, probably those who operate in, under the thematic category, it could be much higher, probably in the range of 7 to 8%, as we speak right now. So that offers a significant headroom to, tactically deploy as well as retract cash from the markets at the same time while maintaining enough buffers for redemption. So these two are key examples of, how cash portion is not really steady across the board. It really depends on the kind of fund and the context. Like I said earlier as well, the context is really important. The timing of the context is really important.
We take that point. We'll discuss about whether cash components are different things for debt and equity funds, but you've very helpfully given us or provided us a table as well. So let's try and understand that. What are the cash levels that different AMCs have at the current levels? And, should investors worry when the cash levels are higher? Is that a sign that maybe AMCs are finding valuations to be higher, or it's the time to redeem some of the money?
So, cash could indeed be one of the lead indicators. In a world where most decisions are made basis hindsight, I feel cash allocation is one of the very few lead indicators that can actually help make a very good decision in terms of understanding how is the fund viewing the market and how does the fund wish to play the market. First thing right off the bat, I'd like to make it very clear that a higher cash allocation does not always indicate a case for caution. It is not necessary that if an asset management company is sitting on higher cash levels, it means that it is not comfortable with the valuations out there. It is also possible that it is expecting certain more opportunities to come up in the distinct and very near future. That's one reason they could be waiting out. Two, it could be a part of an overall deployment strategy where, a fund house would like to participate in select opportunities at, different intervals. And so it would need cash to continuously deploy, right? So that's another reason. Another third reason why they could be holding on to cash is to, apart from, of course, holding cash for redemptions, another important reason that why AMCs could be holding on to slightly higher amount of cash is if they wish to they wish to participate in one of events also. Like for instance, we do know that mutual funds do participate in several IPOs, especially in the anchor round. So if there's limited visibility of further inflows, or they would like to participate to a larger extent, they could hold off on some cash and then deploy it on that for that very particular one-off event or one-off opportunity that comes across, right? So these are a few reasons, why an AMC could do it. And at an AMC level, if you look at it, the cash levels are very different for different kinds of AMCs. Okay, and it is different majorly due to a combination of three things. One, what's the kind of cash management policy they have to manage redemptions and fund flows. Two, what is their view on the markets and how are they reflecting it via cash as an active call, active allocation? And three, what is the portfolio construct? So if a mutual fund has if an MF house has many index funds and ETFs, the aggregate or the average cash holding levels could be really low. On the other hand, if the fund house has many actively managed funds operating in very narrow universes, having many thematic funds, it is quite characteristic that there could be patches where the levels are going to be much higher. So, for instance, there are a few fund houses where the levels of cash holding has gone up in double digits, almost above 12 and a half odd percent. It would include the likes of PPFS mutual fund. It would include Quant mutual fund. It could include Shriram mutual fund, Quantum mutual fund. Now, for each of these funds, right, with a cash allocation of, let's say, at an aggregate level of, beyond 12 and a half or percentage of the total assets, equity assets specifically, it may, be attributable to the kind of funds that they have as well as their current view on the markets. Most of these AMCs have been really vocal about their view on the markets and how they may not be very comfortable participating at current levels for some of their funds, right? Now, one thing that's very important to understand is, even if for instance, let's say a fund house has a small cap fund, but the AUM of that small cap fund is a large proportion of their total asset base, and they are not comfortable to deploy in the small cap universe at this levels, the overall aggregate cash holdings could seem slightly higher versus relative peers, right? So, this is one example of how nuanced, interpreting this entire cash allocation thing could be. And most of these details are public domain, right, and very easily available. It does make sense for, each one of us as an investor to not just look at the cash allocation, but try and interpret the reason and the context behind such allocations.
Okay, all right. That's a very helpful explanation because sometimes there's fear, right? When the cash levels go up, that's the usual question. Are you keeping a lot of cash currently, considering the market levels again at a record high? So that's the question a lot of AMCs have to answer as well. Nirav, we had a lot more questions, but we are completely out of time today. But thank you so much for joining us today and explaining this important aspect of mutual fund investing to our viewers. With that, we'll take your leave on this edition of Mutual Fund Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.
Allied blenders and